So let's start discussion on the structural liquidity statement for the development financial institutions in a specific perspective of NaFID, National Bank for Financial Infrastructure and the Development, where how the RBI frameworks will utilize this bank and how the RBI time buckets and key terms and what is the definition exactly the structural liquidity statement will look like. So let's move on this step by step, and I'll give you the detailed explanation on this topic, and I'll also give you the five-step process to build structural liquidity statement. And lastly, we discuss on the NaFID case study snapshot. So let's discuss on what is the exact structural liquidity statement and why it's matter for the RBI framework and why the National Development Bank will follow the rules and regulation which defined by the RBI. So the definition itself state that the statement that's showing the maturity wise inflow and outflow across the time buckets. So there are the different time buckets like 1 to 14 days, 15 to 28 days, or more than the 29 days to 3 months and 3 months to 5 years. So these are the time buckets where different kinds of the inflow and outflow are for the bank. So on that basis we need to that statement that's showing how much the inflow in that time frame and what how much the outflow in that time frame. So that statement we call as a structural liquidity statement. Guys, as a bank, we they need to manage their liquidity ratio, and to manage their liquidity ratio, they should know what are the assets or what are the liabilities are mature in which duration or in which time, and what are the inflow, what are the amounts coming, so they can manage their liquidity by analyzing these things. So that's why they need to manage the structural liquidity statement in there. So the RBI, it is an RBI guideline. So DBOD BP line number of 5621 04098 for 2012-13 plus updated in 2025. So these are the guidelines they mention that the structural liquidity framework for the RBI, and the purpose of these for the development financial institution like National Bank for Financing Infrastructure and Development is to monitor the funding gaps in long term infra finance. It is on the most important lines, guys. So monitoring and funding the gap in the long term infrastructure finance or long gestations period finance, or it's and the special purpose vehicle finance, and it ensure for disbursement and meet the asset liability management compliance. So it ensure the smooth disbursement on the basis of the disbursement request from the borrower, and meets the asset liability management compliance which is defined by the RBI. So let's move on the next slide, which is the most important slide where we discuss on the RBI time bucket and the key terms. So there are the four categories of time bucket which is defined by RBI, and what are the outflows for the cash and what are the inflows for the cash for in that time budget. And I'll provide you example. Let's suppose step by step. If suppose if have the time buckets as 1 to 14 days, so where the casa volatile or the commercial paper maturity, these are the outflows example for the banks to bank need to pay, and the inflow cash or excess statutory liquidity ratio that bank have. So these are the inflow example, that is the positive thing. And then the 15 to 20 days where the term deposit interest rate bank need to pay for the borrower or the and then the inflow for the T-bills maturing. So some T-bills that maturing within the 15 to 20 days. So that is the inflow of the examples. And then the 29 to 3 months for the bond borrowing, where the bonds or the borrowing issue or the bank will purchase. So that issue the bank, so bank need to pay their interest rate or the principal or the borrowing. And then the inflow is a the loan EMI or the investment capital. So loan EMI principal or the interest will receive to the bank, or the investment capital which done by the bank, or the rental income, which are the inflow for the 20 to 39 months, and then the 3 months to 5 year plus time bound is the different thing. So infra loan disbursement. So the bank will disburse the infra loan. So is then the huge long duration, and then the inflow example is long term bonds and the capital. So that's are the inflow long term bonds and capital funds. If the development financial institution issue the bonds in the market, so that's the funds that inflow for the bank and the capital. And once that fund is completed, so that's the bonds and borrowing, it comes under the outflow for the banks. Let's discuss on the 5 step process for build the structural liquidity statement. So it's an the 5 stage process where we can build the structural liquidity process. So in first stage, we data extracts, we GL, treasury, and the loan system data that we extract from the existing system with ETL or ETL process, extraction, transfer, and load data. So different process, or in the Excel forms, just copy and paste. So extract these data from the SQL, and then behavioral assumption. So CASA split, prepayment, drawdown, or the board approval. So these are the behavioral assumptions we consider while doing the structural liquidity statement. And then the splitting the rules, RBI appendix IVE plus July 15 circular. So we identify that rules and accordingly apply that rule while the structural liquidity statement we are creating. And then gap calculation, net gap or the cumulative gap per bucket. So what are the inflow and outflow gap for the per bucket, how much the inflow we are expecting from that bucket, that the time bucket, or the how much the outflow we are expecting for that time bucket. So that's we analyze. And then finally we do the ALCO reporting, compare with internal limit and take actions. So what are the limits we have? What are the RBI limits provided? And accordingly, we will take actions to eliminate these the structural liquidity framework. So let's move on the case study slide, guys. So I'll always prefer the case study so you can understand that very well. So there is the asset profile, 70% loan in greater than 5 years time bucket. If the let's suppose and understand what are the assets and what are the liabilities for the bank. So guys, in a simple term, asset is a thing that will make a cash for you or that generate the interest for you. But liability is the thing where you need to pay. It is you need to pay in the principal and the interest to the lender for you. So the assets are the loans like car loan, home loan, credit loan, or the term loan are the assets for the bank. And then next the liability profile. So if bank issue the like NaBFID issue the bonds in the bond market, so there the tenure, and that is the liability for where the bank is liable to pay the principal and interest rate for the bond borrowers. Okay, so that's the thing is there. And then key risks. So negative cumulative gap in 1 to 3 year bucket, refinancing risks, and mitigating and maintain a 30 days HQLA. Quality liquidity assets are the most important, and diversify the bond tenure and the credit lines for these things. So these are the case study we understand. So guys, this is the end of this very important topic for the development financial institution, which is a structural liquidity statement. So if you are interested in to go the job in the development financial institution or the top big four organization, so please do like and subscribe my channel. I am creating on such hot topics videos so you can understand that concept very well and get the better opportunity. Once again, thank you so much guys attending this interesting seminar.